Good morning, good evening, and good day to wherever you are. Welcome to our webinar on social impact investing. I'm Yogesh Andlay, Director of Wheels Global Foundation. Wheels was started in 2006 and incorporated in 2013 by alumni of the Indian Institute of Technology. Our mission is to offer technology solutions to scale efforts for water, healthcare, energy, education, rural livelihoods, and sustainability. Where solutions do not exist, we encourage research and development at the IITs and other similar institutions through sponsorship. We work collaboratively with partners like IEEE, CII, Mission Samriddhi, Sevak, Spoken Tutorials, and others. We are a volunteer organization and depend on the generosity of our many donors and patrons who believe that scale can only be achieved by leveraging technology. After implementing many projects for clean water, healthcare, sanitation, education, etc., we embarked on an integrated approach for smart village development. Our first such initiative is in the Aravalli district in Gujarat, where we are working on many projects that were jointly prioritized by students from IIT, the local panchayats, and is being implemented by partners like IEEE and Mission Samriddhi. You may have seen the PowerPoint presentation earlier, which lists many of such projects and how you can get engaged to work with us. This will also run at the conclusion of this event. You can also get additional information at our website, www.wheelsglobal.org. There's also a donate button if you wish to contribute to our efforts. A quick disclaimer: all views expressed by the speakers in this webinar are their own and are not necessarily reflected or endorsed by Wheels Global Foundation or its board and its members. Now, a few housekeeping messages. All attendees are on mute mode throughout the webinar. If you wish to speak or if you wish to ask a question to the speakers, you may do so by entering in the Q&A box or chat box. If you need any help, please chat with one of us by raising your hand or typing your request. We will try and attempt responding to your request in the best possible manner. If your question remains unanswered, we will attempt to send you an email at the end of the event, and you may also send us questions by email to info@wheelsglobal.org. A recording of this event will also be available on our website. Impact investing is rooted in the heart. The seed is rooted in the thought, I want to make a difference. And this thought triggers an urge to explore how and where can I do it. Today, we have an array of very distinguished speakers: Vikram Gupta, Mukesh Sharma, Meyyappan Nagappan, and our very dear Arjun Malhotra to guide us about social impact investing. And now it's my distinct honor and privilege to introduce the moderator for this webinar, Mr. Sanjay Kadaveru. Sanjay is a graduate of the Indian Institute of Technology at Madras and the Kellogg School of Management at Northwestern University. Sanjay is the founder and president of Action for India, an initiative to help social entrepreneurs in India overcome barriers to scale and achieve greater impact at the bottom of the pyramid. Action for India connects social innovators with impact investors, mentors, technology resources, government contacts, and local partners. Launched in 2012, AFI is headquartered in New Delhi, India, and has a chapter in Silicon Valley, California. I now invite Sanjay to take over and carry on this proceedings of this webinar. Sanjay, over
Thank
to
you. Thank you, Yogesh, for the kind introduction and for setting the context for what promised to be a very enlightening 90 minutes or so of this webinar. Firstly, I want to give a shout out to my good friends Suresh Shenoy and Hiten Ghosh, whom I've known for more than 15 years from our days working at the 2005 Pan IIT Alumni Conference in Washington, DC, one of the best IIT Alumni conferences that I've had the privilege of being part of. Since then, I've been in regular touch with them, and as they built Wheels from just an idea to what it has become a true force to reckon with in the impact sector in India. And I'm particularly kind of appreciative of the work that Wheels does in terms of being able to leverage technology for scaling social impact in India. In this day and age, when we talk about all the 4G technologies, AI, ML, big data, analytics, when you talk at all the big problems in a country like India, I think such an approach is the right approach to follow. And I commend the entire Wheels team for the work that they do. In terms of this is a panel on impact investing, social impact investing. And I think it would be important to kind of just say a few words with respect to what is impact investing, what is social entrepreneurship. Most of us in the audience are more or less likely to know in terms of startups and entrepreneurship. But the moment one uses the word social enterprise, it sets a little bit of ambiguity in most people's minds. And unfortunately, there's no universal consensus as to how to define a social enterprise. And different organizations, different individuals use different definitions. And one definition that we've used at Action for India, the organization that I run, goes something like this. Any organization that's developing products or services that proactively, by intention, not as a byproduct, make things better for those in the underserved communities and attempt to do it at scale. So the bottom of the pyramid orientation and the ambition of scale are critical elements for what we consider to be social enterprises. And social enterprise can either be for-profit or not for profit. But again, some organizations are disproportionately biased towards the for-profit models and others for the not-for-profit approaches. And there's no right answer. I mean, the problems are huge. As they say, horses for courses. Some situations lend themselves to a more effective not-for-profit approach, and other situations lend themselves to more of a for-profit approach. And today, just to clarify to the audience, we are going to be focused on the for-profit social entrepreneurs and the equity-based impact investing. These should be the two focus areas. And we have a truly world-class set of panelists with us today. We will kind of, I'll be having an opportunity to introduce each of them. They'll have the prepared remarks, and there'll be a Q&A with me and with the audience as well. But one thing again, so we talked about social entrepreneurship. When you talk about impact investing again, what happens is that in a country like India, again, you would have heard the depressing statistics in the mainstream media. Things like 1/3 of the country lives below the poverty line. 2/3 of the country lives below $4 a day. Half the country doesn't have access to clean drinking water, sanitation, electricity. So it can, make one truly cynical. I mean, one might adopt the approach, kuch nahi hone wala hai, chodo yaar, kuch nahi karenge. But for those of us, I'm sure that all of us who are on this session, we have an interest not to be a complainer, but to be part of the solution, to do our bit in contributing to making a difference on the ground. So to those of us, I'd like to submit the following. When you talk of solving problems of the scale that we have to deal with, typical people, the typical entities that people look up to, there's the government, there's the corporate sector, there's the civil society. Government, very clearly, is the first entity that comes to mind for most people. And unfortunately, most governments, irrespective of which geography, not necessarily in India, they they come to power to solve the problems, people's problems. But again, they don't have unlimited resources to solve all of the people's problems. So they are constrained in that manner. When you talk of the corporate sector, again, the situation is that their primary priority is primarily in terms of maximizing profit. They are concerned most of the time with respect to shareholders. And only recently have we heard about the stakeholder capitalism rather than just shareholder capitalism. And in a place like India, through the capital, there's a CSR activity, corporate social responsibility. Through that, we are seeing some efforts to solve some of the social problems. But again, that is the constraint that they have. Then civil society, again, a lot of heart, a lot of compassion. But again, in most of the not-for-profit organizations, you have to kind of go to donors year in, year out. And there's only so much that people are willing to give on a continuous basis. And that is their constraint. So one hypothesis has been that to solve these mega problems, I think if you were to kind of identify the young, energetic social entrepreneurs of the country who are leveraging market-based approaches, sustainable business models, and if you can identify them in the early stages and then flood them with resources, be it funding, be it mentors, be it technology resources, be it government decision makers, that is the approach that's likely to have the biggest probability of success in making a dent in the universe. So here is the context. This is the context why the world at large and India in particular needs to pay attention to for-profit social entrepreneurs and equity impact investors. And again, because of the size of the problems that we have been able to, India is considered as a test bed for social innovation. The solutions that are being developed in India are being developed with a frugal innovation approach, sometimes referred to as the Gandhian engineering approach. And these solutions with minor customization it's possible for them to be carried over to other geographies, be it Africa, be it Latin America, be it other parts of Asia. So there is indeed a great role and responsibility for these impact stakeholders from India, be it the social entrepreneurs, be it the impact investors, to lead the way, to show the pioneering approach to solve some of these mega social problems for the whole world. So with that context, I'm going to now introduce the panelists that we have. And we have a truly, as I said, world-class, diverse set of panelists. We have a couple of investors. We have a social entrepreneur who is executive chairman of a social enterprise. And we have somebody from a law firm who can talk in terms of all the legal structures and the opportunities and the challenges with respect to getting involved with social enterprises and impact funds. Let me first introduce the first speaker, and I'd like to invite Mukesh Sharma from Menterra to share his prepared remarks for about 3 to 5 minutes. And I'd like to begin, before I invite him on board, by sharing about his profile. Mukesh is a co-founder and managing director at Menterra Venture Advisors Private Limited. Mukesh is a co-founder of Menterra, an investment fund platform that addresses the biggest issues facing agriculture, healthcare, and education in India through private investments that target commercial returns and big sectoral impact. Over the last 18 years, Mukesh has invested in and worked on deals in several emerging and frontier markets. He has raised capital from a diverse set of investors. Earlier, he was the chief investment officer at Wilgrow, India's oldest and foremost social enterprise incubator. Mukesh has played an integral role in developing first-generation companies through the Valley of Death, as it's called. He's going to talk about what the Valley of Death means in his prepared remarks. He believes that non-linear outcomes are more likely to be achieved through big, game-changing ideas that leverage the latest scientific and technology breakthroughs. Mukesh has advised the promoters and boards of several companies. He's been a non-executive director on the board of Biosense Technologies, Omics Labs, Kadaveru Diagnostics, and Concept Learning. With that, over to you, Mukesh.
Thank you, Sanjay. It's a great honor to be interacting with you all today. I will talk about my personal journey that led me to launch Menterra Social Impact Fund. I'm also going to talk to you all about why, what, and how of impact investing, and hopefully persuade many of you to join the much needed and growing family of impact evangelists. I know all of you do a lot of philanthropy, but there is a scope to doing a lot more, and I'm hoping that we will be able to cover that today. I am perhaps one of the very few non-IITians on this group today. And in fact, till I graduated, I did not know much about IIMs and IITs. So I grew up in a small town in Kutch district of Gujarat. It's called Gandhidham. This town was created at Gandhi's request to rehabilitate refugees of partition in 1947. I studied at an aided vernacular medium school and college with minimal exposure. I mean, we read only Gujarati newspapers. What happened outside of my district, really didn't know much about it at that point. Computer, internet was not as ubiquitous. I left my town as a result of 2001 earthquake with first-hand experience that made me aware of how inadequate, inefficient, and unevenly distributed access to good health and education was. My relocation from Kutch, triggered by the earthquake, was a blessing in disguise for me. I completed my CFA degree and gained good exposure while executing deals. Sanjay talked about several emerging and frontier markets. But my personal experiences stayed with me, and I really wanted to address some of these issues. So the goals of improving the quality of education and healthcare for masses come from my personal experience and motivation. Many of these challenges are difficult and multidimensional. The vibrancy and discipline of markets, combined with the soul of mission-oriented impact investing, is a great way, I believe, to put together best mind and resources to tackle these huge development challenges. So with that background, let us now talk about impact investing. I've been doing this now for more than 10 years, and I've had many people come and ask me, is it really needed? Is impact investing needed? Many great thinkers and leaders have over the centuries declared that all men are created equal. But the fact is that all people are not created equal. They don't live or die as equals. Our social, political, and economic structures sustain, reinforce, and increase the inequality around us. While the economic poverty is very visible, we don't always realize that poor countries and the poor people suffer the most from the climate change. They have contributed the least, but they suffer the most. The current pandemic is a great example of this irony. The poor had no role in triggering or spreading this virus, but they are paying a disproportionate economic cost for this pandemic. And then there is gender inequality. Melinda Gates is right when she says that no matter where in the world you are born, your life will be harder if you are born a girl. So the genesis of Menterra lies in not only rejecting this inequality, but also working towards solutions that create better conditions for equality. We believe that with sufficient innovation and disciplined execution, market returns can be delivered. And they can be delivered alongside a deep impact at scale. We have demonstrated that through our work at Wilgrow. We demonstrated that now with Menterra. We have delivered exits that have given returns and very deep impact. I'll talk about it later today, probably in the Q&A part of it. We all know that the financial markets and the business have always focused on maximizing returns, which has been measured only in financial terms. There's nothing wrong with profits, but does it have to be put ahead of all other considerations? We all know that markets are not efficient. We know that markets do not work for everyone. Millions of poor around us aspire for and are willing to participate in the market economy. Like you and I, they want good education for their children. They see it as their passport out of poverty. But after taking loans and paying for the education of their children, they have a root shock waiting for them when their children do not get jobs or get jobs that really do not pay enough. So the participation in the market, unfortunately, comes with penalty. Let us call it poverty penalty. Penalty of fewer choices, poor quality products that do not address the pain points. As a CFA charter holder and as a venture capitalist, I understand that fiduciary duty to deliver what our investors need is an important priority. However, the markets are currently not even pricing impact. Our underwriting and investing models do not factor it in. Today, a lot of investors are demanding impact. The investment industry will need to work on the current narrow definition of the fiduciary duty and really align it with the priorities of the owners of capital. Investing models, therefore, will most certainly be re-engineered to optimize for social and environmental returns alongside financial. There are many who believe that addressing these inequalities is the job of the government and those with philanthropic intentions. Let's talk about the largest philanthropic organization. Maybe Bill and Melinda Gates Foundation is one of those. Yeah, even with $100 billion, if you were to spend it all in a single year for a country of our size, less than $100 per capita, would that be enough to address the issues? It won't be. So should we really leave this to the government? Irrespective of our philosophical and political views, we know that it would not be feasible. Let us look at some data. I'll just, I am not able to share my screen. Okay, I was going to talk about a chart, but screen sharing is disabled. Okay, let me just talk about it without it probably, without that chart. So if one was to look at pre-pandemic budget just before the pandemic hit, for the financial year 2020-21, if you look at the top 5 expenditure lines, what are those? Interest, defense, grant to states, subsidies, and tax administration. Agri allocation was probably increased to about 5%, but significant part of this was direct cash transfer to farmers. With many reforms and good initiatives, we are able to allocate still only 5% to education and healthcare combined. Right? So less than 10% of government's expenditure goes into health and education and agriculture. A lot of it is subsidies and salaries. There's been a big shift in the disease profile of our country to chronic diseases that are costly and have a big impact on the quality of life. Beyond large cities, the health infrastructure is poor with low insurance coverage. So can we afford to leave healthcare completely to the government? The new education policy announced by the government includes many welcome initiatives. But is 2% of the budget allocation sufficient for a country going through favorable demographic shift? It's not. Barely 1% gets spent on science and technology. With the global economy moving towards the knowledge sectors, we need a lot more than what the government can provide for. And we know that government is trying hard. There have been many initiatives, but with poor tax compliance, very low tax to GDP ratio below 10%, and structure of the government expenditure, it's not going to change very rapidly. So there is really no option but to channel more capital and resources to ensure that all basic needs of education, job, and healthcare is delivered to every person. The power of markets needs to be leveraged to build a more equitable society. It's not a question of whether, it's a question of how much, how soon, and to what end results. Now let us look at the opportunity.
Sorry, Mukesh. I think we'll cover the remaining points in the Q&A part. I thought we'll just do about 3 to 5 minutes for each of the panelists, and we'll come back to the things that are remaining. Next, I'd like to introduce our next speaker. This would be Vikram Gupta. Vikram Gupta is the founder and managing partner of IDCap Ventures, a US $200 million venture capital fund that invests through the alumni ecosystems. He has over 25 years of experience in private equity, business consulting, mergers and acquisitions, strategy and operations in healthcare and life sciences, education, consumer goods, and other industries. He has held leadership positions across various well-known companies in India and abroad. Prior to founding IDCap, Mr. Gupta was the founding member at Ajay Peramal-sponsored US $100 million healthcare-focused private equity fund that he conceptualized and raised in 2008 when the world markets were going through turmoil. Mr. Gupta is the co-chairman of the PEVCAI, the Private Equity and Venture Capital at ASSOCHAM, and is an active member of the Indian Venture Capital Association and CII, the Confederation of Indian Industry. He received a distinguished Alumni Service Award from IIT Delhi last year. Mr. Gupta has completed his BTech in Chemical Engineering from IIT Delhi and has an MBA degree in Strategy and Finance from Case Western Reserve University, Cleveland, Ohio. Over to you, Vikram.
Thanks, Sanjay. Thanks a lot for that, for my introduction. And it's a pleasure and honor to be here amongst elite panelists. And I think I really love the topic of discussion here, and I'm very passionate about this whole subject. And I think something which we believe also as the core thesis at IVCAP, where we believe that impact has to be at the core of investing. And I think while people may argue that venture capital by definition is actually creating impact because of investing in early stage entrepreneurs and therefore encouraging small enterprises, small entrepreneurs to really the opportunity to really scale up their businesses and therefore generating employment across sectors. But I think what we've realized over time is that there's a meaningful way to measure this impact, and we got exposed to sustainable development goals a couple of years, and we got quite enamored by the way these goals are structured and positioned. And when we actually went deeper and studied these 17 goals, we realized that these were very nicely put together by the United Nations. And behind these 17 goals, there are 169 targets. And behind this 169 targets, there are very specific metric which can be applied for tracking very specific measures of impact. And when we looked at our own portfolio, we currently have a portfolio of 30 companies across different sectors. We could see that some of these goals can clearly be mapped onto these areas which these companies are focused on. While historically we were not necessarily positioned with the SDG as a framework, while at the time of investing itself, identifying areas for sustainable development goals. What we've done now, as we launch our next fund, which is a $200 million fund, we are calling it an SDG fund. And what we're doing as part of that is basically identifying companies with very specific areas where they can make an impact across very specific goals within the SDG framework, and then track them monthly, quarterly, annually on these specific goals and targets and the metric to be able to quantify the actual measure of impact. And not everybody has to try and address every goal out of this. People can just pick up one goal and really try go deeper into that. And that's where we realize that there is a huge value when you actually start looking at venture capital investing with an SDG lens. So with that, in fact, we've already started implementing that in our portfolio. And in fact, the fundamental thesis of IVCAP also comes from the fact that we would want to give back whatever value we're creating in the venture capital ecosystem into the education system, and therefore at the grassroots level of innovation. And therefore part of our earnings actually go back as endowments to the IITs. In fact, we were instrumental in setting up India's first endowment fund at IIT Delhi, which is targeted to be a $1 billion fund. Which was launched by the Honorable President of India in October of 2019, where I was also there at the launch, to make the presentation to the Honorable President at Rashtrapati Bhavan. But the idea there was to really encourage this whole concept of endowments, to grow across the other education institutions, and therefore create this impact at the fundamental grassroots levels across the education system, and therefore further promoting innovation across the system. So that's something which we are quite excited about. And of course, would love to talk more about what we're doing. But I think that's what I wanted to say as the introduction of what we're doing and what we're excited about.
Thank you, Vikram. And in the Q&A section, you'll have a chance to kind of dig deeper into the various SDG goals, which goals are attracting the most amount of attention and funding, and how some of the social entrepreneurs in the audience can leverage those pieces of data and information. We'll come back to you. Next, I'd like to invite, I want to introduce the next speaker, Arjun Malhotra. Arjun has been a pioneer of the Indian IT industry. He has served as a chairman of Headstrong's board of directors before its acquisition by Genpact in May 2011. Prior to Headstrong, he was chief executive officer and chairman of TechSpan, which merged with Headstrong in October 2003. Arjun has a long string of entrepreneurial successes. He co-founded the HCL Group in 1975, taking it from a 6-person garage operation to one of India's largest information technology companies. The first leading Indian entrepreneur to relocate to the USA, Arjun took over HCL's US operations, now known as HCL Technologies, in 1989 and grew it to nearly $100 million annual revenues. In 1992, he ran the HCL HP joint venture in India, and in 1996, he set up and ran the joint venture with Deluxe Corporation. Arjun is currently serves on the board of governors of the Indian School of Business at Hyderabad and the IIT Kharagpur Foundation. He's a past co-chair of the Global Pan-IIT Alumni Association. He's a charter member of TIE, having previously served as the chairman of their global board. Arjun studied at the Doon School, Dehradun, graduated from IIT Kharagpur with a BTech honors in Electronics and Electrical Communication Engineering, and received the prestigious Dr. B.C. Roy Gold Medal. In 1985, he had attended the Advanced Management Program at Harvard Business School. With that, over to you, Arjun.
Thank you, Sanjay, and welcome everyone to this webinar. I think Sanjay has pretty much defined what social entrepreneurship is. So I'll sort of, again, like some of the earlier speakers, discuss my story and say why I moved into this area. So, basically in HCL, Headstrong, obviously you want to run the company and grow them, but one of the basic objectives was creating jobs. And really, especially in the 70s and 80s, job creation in India was a really important part of what we were doing in HCL. When I sold Headstrong to Genpact in 2011, I decided that I'd focus my time on something, in addition to creating jobs, work with some emerging entrepreneurs who want to make self-sustaining companies which will have some social impact. And basically, with my background, I thought I'd leverage technology to provide better healthcare and education outcomes to the economically underprivileged in India. And it so happened that a group of engineers who worked with me at HCL America came to me with an idea, and they needed some advice and wanted to, see how to go forward, see how to scale it. And we started a company that we have bootstrapped, which really addresses the problem of healthcare for the underprivileged. Basic model is very simple. We decided that we would, how should I put it? That we'd follow the principles that Prahlad had set up. The bottom of the pyramid, it's huge in India. So we charge something like 25 rupees a transaction to do triaging. We have a monitoring application. We use AI. We now have over 8 million patient records on the system. We do telemedicine. In fact, the Wheels telemedicine proposals are done with the Evolko platform and software. And we are expanding that all over the country. In fact, some of the impact that I would love to share with you is at AIIMS Patna, they had produced a paper where they did, set up rural telemedicine centers for them. And the paper talks about 80,000 consults, telemedicine consults, out of which they estimate they saved 50,000 visits to the hospital, which really means that you did 50,000 preventive maintenance kind of calls. Also, their estimate is that if they hadn't done that, each person would have to come to Patna, spend a night there, come with an attendant, and it would have cost them approximately 2,000 rupees. So if I multiply 2,000 by 50,000, I come to 10 crores. And when you think of saving poor people, poor rural people, 10 crores, it is a substantial number. And this is just with one hospital, with I think at that time we had 41 telemedicine centers. So as this expands, we expect a huge, huge difference. The limitation we are seeing in India, and in India there are always limitations, is that I don't have doctor time available to take all the calls. And so you have to look at some innovative solutions that we are now addressing to try and scale that particular operation. A number of other things I think that came out of that Patna experience, which I think I'll share, some of which is, how do I put it? It's as Sanjay mentioned, it's the frugal kind of innovation that we think we are so good in India, and we are so good in India. One of the things that we noticed when we were in Patna at the new AIIMS that was set up at that time was that patients were coming to the hospital in autos, in three-wheelers, not in ambulances or cars. And we discovered that the reason for that was when you go through crowded, narrow streets, the auto can get through, but cars and ambulances tend to get stuck. So based on the recommendation of the then director of AIIMS Patna, we developed an app in Hindi, and he spent a number of weekends at the quote unquote Central Park there, downloading it to the smartphones of all the auto drivers in the city. So today, technically, if you're in Patna and you have the app and you fall down and break your hand, you press it, and one option is I am injured. You press I am injured. There's someone monitoring all these cell phones. He knows your location. He knows the location of these 10,000 odd autos in the city. He'll call an auto driver near you, tell him to pick you up and get you to the hospital. So it's sort of Uber, but in a very different way that helps the healthcare business. So, you look at it, it's really jugaad, as I call it, but we are using our frugal resources to be able to become more efficient in what we are doing in terms of providing better healthcare outcomes. The other nice thing about telemedicine is that technically, if every village in this country has a telemedicine operator, and when I say a telemedicine operator, we need two people, because women in rural areas will not let a man come in and do their vitals. So if I look at employing two people in each of the 600,000 villages, you're talking of an employment of over 1 million people. Obviously, all 600,000 villages will not need a telemedicine location. But even if half of them need it, you're talking of something like 500,000 plus jobs that can be created. That not only can be created, where they will earn something like 15 to 20,000 a month, and that they will provide better healthcare outcomes to people. So, I think you have to, how do I put it? If you want to scale in India, you have to work with the government. And I know that's very frustrating for a lot of people. And I'm quite happy to tell you how we did it, because you just don't go to government and say, let's do this. It's unlikely to happen unless you have a contact and they really want to do what you want to do. So I will be happy. I mean, I think I've taken my time. I'll be happy in the Q&A to answer any of those questions in case they need.
Thank you. Thank you, Arjun. Before I invite the final panelist, I introduce him and invite him to speak, I just want to share with the audience that, if you have any questions immediately after this prepared remarks of the last panelist, I will have some few questions, but please jot down your questions in the chat section, and the Wheels team will invite you to pose the questions to the specific panelists after this segment. So with that, let me introduce the next panelist, Meyyappan Nagappan. Meyyappan is a leader in the international tax practice at Nishith Desai Associates. He leads the tech and tax practice, impact investment, social finance, tax policy, and GST practices at Nishith Desai Associates. He regularly advises several top technology companies on tax and structuring issues from an international tax and GST perspective, including on upcoming technologies and digital products such as blockchain, crypto, and gaming. He has done extensive work advising some of the biggest nonprofit foundations, development finance institutions, and impact investment funds, including structuring advice in relation to India's first billion-dollar education outcomes fund and development impact bonds for the British Asian Trust. He regularly speaks at the International Bar Association conferences and other tax conferences, both in India and abroad. With that, over to you, Meyyappan.
Thanks a lot, Sanjay. It's an honor to be here as part of a very eminent panel and talking about impact investment today. I think my opening remarks would be, as a lawyer, I think we have advised several clients on different kinds of structures that they wanted to do in India. Primarily, we have worked with clients who are cross-border and predominantly on the investor side. The first thing I think I would be taking up is just focusing a little bit on the terminology around impact investment. There are several terms that you might have come across in this space, socially responsible investing, venture philanthropy, finance first impact investing, impact first investing. So I just thought, it will be good to break down some of these concepts a little bit first. So I think it's helpful to think of it as being on a continuum. So you can start with traditional investing on one side. And if you move one step towards impact investing, there is something called socially responsible investing, where basically you focuses on market rate returns, but you try to not invest in certain sectors like possibly tobacco or something, or guns that that create harm. So I think avoidance of harm is the guiding principle there. When you take philanthropy, pure play philanthropy on the other end of the spectrum, the idea there is no return expectations there, it's an absolute grant. But when you take one step towards the impact investing framework, there's something called venture philanthropy, where the idea is to take the risk and try to mentor the parties who receive the funding, but with the expectation that the grant capital should be returned where possible, but there's still no return expectations attached there. With impact investing, of course, as a concept, it's that you can achieve both impact and also market rate returns, and that's where it sits in the middle of that continuum, between traditional investing and traditional philanthropy. Now, of course, this is all, I think, to be taken with a pinch of salt, because if you see academic texts and discussions around the world, these terms are sometimes interchangeably used, and everybody has their own sort of understanding of what is impact and impact investing. And that's where the idea around finance first investing and impact first investing comes in, where is the focus on returns or is the focus on impact? And a couple of concepts that have also been developed subsequent to that is you would also come across terms like blended finance and outcome funding, which are upcoming concepts, which is basically in blended finance, you will converge or you will use both charitable and for-profit money to achieve in a certain structure. So it de-risks certain transactions and makes efficient use of grant capital. So that's a new upcoming concept, and it also has that leverage effect in terms of you use grant capital to attract for-profit money into developmental activities, and without expending grant money in a structure like that. The other one is outcome funding, where basically the person who takes the risk or the investor gets a return only if pre-agreed outcomes are achieved. So the risk profile is much higher. What is impact and what needs to be achieved is a lot more documented in a lot more detail. So this is sort of on the few concepts I thought would be helpful for people getting into this industry to know. The second thing I thought I'll quickly cover is something that comes up, and there are, on the legal side, there are several things that are moving in this space. So one is, of course, the social venture fund has already taken a shot at defining what a social enterprise is. So there is some form of a legal definition there. But when we're talking about social stock exchange or looking at how the market is trying to negotiate what is impact and who's a social enterprise in some of these transactions, I think there is a lot of gray areas currently. There's lack of consensus on what is a social enterprise, what is the correct metrics to track for different kinds of impact, and how do we define impact. And as Sanjay correctly said, I think currently the law does say that intentionality is what matters when coming to defining what a social enterprise is. And in terms of metrics, the social stock exchange report has actually made quite a bit of progress, because when they are looking at it from a capital markets perspective, the intention of the social stock exchange that was launched last year, the announced last year by the finance minister, was to try and use the market solution to drive money towards social enterprises, which might be both for profits and non-profits. And for any efficient market to work, you need a good bench strength of enterprises that are available with the ability to absorb capital, but also at the same time able to, investors have to be able to compare like for like. There has to be some standardization of reporting on how to compare outcomes and metrics on impact that gives them the confidence that at least some bare minimum impact has been achieved. At the same time, I think the debate right now at the committee level is how high the threshold should be. You set the threshold too high and not many enterprises would be able to receive the funding. If it's too low, then that may not give investors the adequate confidence to go ahead and invest in these enterprises. But on the pure metric side, what needs to be tracked and how should impact be recorded, I think there's a significant progress made there. However, the framework is pretty complex when it comes to this. You have several different laws that apply depending on different kinds of investments. You will have, especially on cross-border, you will have income tax, FEMA, external commercial borrowings, or the FDI regime. You have fund regulations. So impact cuts across all these kinds of laws, and different structures include bespoke structures where there is an equity investment being received in a company, or a debt investment being received towards a certain particular purpose, like green bonds, etc., sustainability bonds. You also have fund structures which could either be category 2 impact funds or social venture funds, which are focused on doing impact investing in the equity space. You also have the upcoming social impact bonds or development impact bonds, which, despite the bond terminology, are actually very different kind of structures, because they are trying to unlock money from non-profits and give returns to for-profit investors. So as I said, somebody puts in the money up front and they get a return of 10% in the form of a grant, which covers their capex and plus gives them the 10% return, but you don't receive it as a service fee or as a capital gain or as a dividend. You receive it as a grant. So these are novel structures that are coming into the space, but transaction costs are high. The structuring is very costly and difficult and complex because of the legal and regulatory regime. And where we have seen impact investing thrive in other countries is where the government is an active driver of investments in this space, and there is a supportive policy framework saying that this is a good thing for the country to happen and for enterprises, and they actively get engaged in these sectors. The last thing I thought I'll quickly address is, in some of these structures, when individuals are particularly looking at investing into either enterprise in India or participate through a fund structure, there are several limitations that significantly dissuade foreign investors. Primarily, in a fund structure, it could be the ticket size, or it could be the fear of tax or other authorities in India asking questions and going on a fishing expedition with respect to high net worth individuals situated outside of India. The second you have an account or filing returns here. So these are all practical challenges that do come up and dissuade parties from entering into this space. But there's a lot of potential, and some of the recent changes in the budget have also, I think, opened up newer possibilities. But at this stage, I think I'll take a pause and wait for further questions.
Thank you, Meyyappan. And once again, I request those in the audience who have questions for the panelists, please start jotting them in the chat section, and one of the Wheels colleagues will be able to kind of give you an opportunity to pose the questions. So now we are entering the next phase of this panel. This will be initially I'll have a few questions to each of the panelists, and then I'll weave in the questions from the audience. Again, the assumption here is that in the audience there are people who want to become social entrepreneurs. In the audience are people who are contemplating becoming investors, either into funds or into specific social enterprises. Or another way to engage with the ecosystem is you might want to be a mentor. Maybe you are a government representative, maybe you're a technology executive, and you want to see how you can kind of help guide, help scale the impact of these social entrepreneurs. These are the broad buckets. So in my questions, I'll try to see if I can extract answers from the panelists which will give you some additional flavor, some additional information as to how to engage with the ecosystem. Let me begin with Mukesh. Mukesh, again, so we know investing, when it talks of, in general investing, the two main variables in the equation are there's the risk, there's the reward. When you talk of impact investing, there's a third variable that enters into the picture, impact. With this new variable, there are a few questions that come in as to in what way is an impact investment different from a regular investment. You definitely are not focusing just on the financial returns, you're also focusing on social impact. But what would be the kind of the metrics for this impact, the social impact? There is this popular misconception. Some of us in the impact investing domain would like to say that, hey, if you're impact investing, then you've got to make do with muted financial returns, or you've got to be more patient because gestation periods of social enterprise are much longer. So can you, first of all, I think there are industry, there's an industry-wide consensus, maybe with organizations like Gen, which has done a formal definition of what is an impact investment. Maybe you can share about that, but also share your viewpoint with respect to, do you think the extent of financial returns and the extent of on-the-ground social impact, are they correlated, or is it more of a trade-off scenario where you have more of one, it necessarily means less of the other? With that, over to you, Mukesh.
Yeah, thanks, Sanjay. So let's start with the definition. I think Meyyappan covered some of it, but Global Impact Investors Network has defined impact investing. Right? According to that, it includes three important attributes. First is impact intentionality. Second is financial returns. And third is measurement. Why is impact intentionality important? So Amul is an impact enterprise. Arvind Eye Hospital is an impact enterprise. Grameen Bank is an impact enterprise. Would we call Uber and Ola an impact enterprise? They have helped many poor people. Right? So a cab or a telecom company, Jio might be doing great work. The cab or a telecom company delivers benefit to work, but may not have the same level of impact intentionality. So that is one part of it. Wherever you see need, you have a scope for philanthropy. Where you see returns, you have an opportunity for investing. And that is why returns are important to distinguish it from any other form of philanthropy. And finally, you can't deliver what you can't measure. So many companies and investors intentionally or unintentionally end up relabeling the existing business activity. And this may sound like a slightly stronger view, but it meets the lowest common denominator around impact, lives touched. And in a country like India, the kind of sectors that one looks at, healthcare, education, agriculture, a lot of things fall within SDGs and ESGs, right? So it is very important to clearly define and measure impact at the outset to avoid accentuating the growing concerns around impact washing. What is impact washing? It takes place when a company or a fund makes impact-focused claims without truly having any demonstrable positive social or environmental impact. And there are reasons why it happens. Some of it is conscious, some of it is structural challenges is what I would call it. Sanjay, your question had many parts, so I don't know if there's anything that I didn't cover. So this is the definition part.
Yeah, maybe one thing you can say, do you think, is it financial returns and social impact, are they correlated, or is it a trade-off? Do you understand, or do you want to elaborate?
I think it really, I understand. I think it really comes down to the entrepreneur and comes down to the institution that is managing that. So let me explain that. Our investment committee has a veto holding member with 40 years of impact experience, right? Who has actually pioneered, mentored many of the impact leaders in the country. So we will not be able to go ahead unless we demonstrate a very strong impact case, impact definition, impact metrics before even talking about investing it. And that actually goes throughout our that actually works throughout our investment process, from first time looking at an application, doing a diligence at every stage it is done. Our shareholder agreements cover it, right? So Otherwise, see, in a for-profit world where we'll probably talk about valley of death, where sustainability is difficult, scaling is difficult, there's always tendency to push for profits, and the impact always takes a backseat, right? So, how do you achieve this balance? It requires deliberate effort. It requires the DNA of the organization to be really focused on maximizing or optimizing for impact. But short answer to your question is both can be delivered. It requires a lot of effort. It requires different DNA, but both can be delivered.
Thank you. Next, I want to go to Vikram. Vikram, again, you've had a very distinguished and successful 10 years or more with IVCAP. You had a fund one, $40 million, a fund two, $80 million. Now you're on to your third fund, $200 million. So what was the trigger for you to, what was a plainly cushy and very successful investment career to think in terms of, calling your third fund as a SDG fund and getting into this whole world of impact and sustainable development goals? What was the rationale? What pushed you over the Rubicon to kind of get into this messy world of impact investing? And again, an extension of the question that I asked Mukesh, you in the fund one, in fund two, you talked about 20%, 25% IRR. And you, I know, are not willing to kind of get any slack with your third fund. You are still going to insist on 25% IRR. So how can you do good and make good at the same time?
No, in fact, I actually don't subscribe to the view that impact means muted returns. In fact, I used to believe in this, to be honest with you, maybe 2.5 years back, when I actually met a family office in London, managing over $4 billion. And I looked at their portfolio of about 247 companies around the world that they'd invested in India, Africa, and other parts of the world. And I was very intrigued to look at some of the data. And when I saw that 41 of their companies were actually SDG compliant investments and made specifically through that framework. And I was amazed to see that those 41 companies, the combined IRRs were 36%. And this was the first time when I was actually exposed to the fact that you don't have to compromise on your returns when you're actually investing through impact lens. And since then, I have been spending very conscious time and effort to understand and study this aspect of investing. Last year, I was in Davos in January, where I met the architect of SDG framework at United Nations. And he explained to me, how this whole framework was conceptualized and created. And it was actually quite interesting to hear some of the views that were presented at that time in terms of, he gave an example of, you could even be investing in a polluter, as in, I was quite amazed with some of these examples. And as long as, and I like how Mukesh actually, brought out those 3 points. And one of those points is intentionality and awareness. And I think even if you're investing in a polluter, if you're investing with the intention to actually make an impact and bring consciously the pollution down, and track and measure the actual metric based on which you can actually say that on a monthly, quarterly, annual basis, this is the level of pollution you have actually decreased without actually impacting the outcome of the business, or actually, in fact, even improving the outcome of the business, is what the SDG framework actually promotes in terms of from an investing perspective. And that was something which was very, very interesting to learn. And then we started looking at our own portfolio. And when we saw that some of these entrepreneurs, when we started talking to them, it doesn't come naturally. If you look at the entrepreneurs in India, they probably wouldn't even understand the difference between an ESG or an SDG or impact investing. And there is a general perception, as you mentioned, that impact investing would mean you may have to compromise on your returns. But as we started talking more to these entrepreneurs, we realized that they were quite passionate about it. They just wanted to be coached about how to really do good without really compromising on achieving their outcomes. And that's when, when we actually started working with our portfolio companies like FT Cash, FinPay, and a few others, which actually picked up a certain goals out of the 17 goals, and then actually started tracking their measure of progress. It actually made them also feel good, and they actually, interestingly, it has brought more structure and process orientation in their minds, and it's brought more clarity in terms of direction. And in the process, they have seen more appreciation from their own customers, from the other investors, and therefore getting more attention even from value creation perspective. So I think that's the excitement which we are looking at, and in fact we believe being the first fund, the first venture capital fund in India to actually clearly articulate saying that we are going to be an SDG fund with very specific objectives in terms of how we're going to drive difference and create impact at the grassroots level. I think that's being seen very positively by our investors in the fund.
Thank you for that, Vikram. Next, let's go to Arjun. Arjun, again, you've been involved with Evolko for more than a decade. And for those in the audience, there are several like you, Arjun, who had distinguished careers as well as an entrepreneur or as an executive. And now they're searching for more meaning and purpose in their lives, and they want to kind of enter the world of impact, whether as an entrepreneur or an investor. So specifically looking at in terms of your own journey as to how did you get involved with Evolko, and in terms of, again, in a country like India, as I mentioned, the problems are huge. And typically for most social entrepreneurs, they are passionate people. They see some problem and it's more of an emotional gut feeling. Hey, I've got to do something, got to make a difference here, and they want to jump in. But there are usually more larger structural forces at play there. And without a clear understanding in terms of what those forces are and whether they are aligned and to help you succeed or they prove to be insurmountable obstacles, you have to make a call about that, and only then zero in with respect to a particular sector, a particular enterprise, and then express your show your commitment and dedication to solving the problem. So share with us a little bit in terms of what was your own decision making framework in zeroing down to your association with Evolko. And then also you alluded to earlier in your prepared remarks in terms of the role of government. I'd like you to talk in terms of why working with government is such an important factor to ensure the success of a social enterprise. And again, here we hear in the mainstream media, hey, government means corruption, government means red tapeism, and keep them at arm's length, don't do anything with them. But again, especially in a country like India, government is such a powerful distribution channel for products and services. Without proactively interfacing with them, there's very little chance that you'll achieve significant scale. So what are your own views in terms of about working with the government, and how has that played out itself at Evolko? Over to you, Arjun.
Yeah, so let me answer the first part first. So, my mother was a medical doctor, but she specialized in preventive and social medicine. And so when I was growing up, I've spent a lot of time with her at rural health centers. And, I sort of saw her getting involved in the National Malaria Eradication Program and stuff like that. So I've never wanted to be a doctor, but I've always lived on medical college campuses, Lady Hardinge Medical College, Maulana Azad Medical College. When I grew up, in fact, when we started HCL, I was living with my mother at Maulana Azad Medical College campus. Basically, so that was one. Second is my whole career from the time, from the time I joined IIT till today has been in technology. I've been in IT. And so when I decided to give up running a company or starting a company, I thought, what can I do leveraging my own knowledge based on my experience? And, having seen rural health centers in the old days, I knew that there were problems there. India, there are two countries in India, one that we live in the cities and one that's there in the villages. And unless you go and see them and spend some time with them, you really don't understand the level of issues that exist there. I mean, there are say in the state of Uttar Pradesh, there are PHCs, public health centers, where one particular village is 80 kilometers away. So think that you're 80 kilometers away from your primary care center, which doesn't even have a doctor. In fact, the community health center may not have a doctor. So the problems are quite immense in India. And so I decided to look at, leveraging my knowledge in technology and in the ability to scale companies, which I had done earlier, and see how I can take that to the problem that existed in India. Had no idea how to approach it. And so, as I mentioned to you earlier, we started Evolko in 2007. Now we are in 2021, and we are still evolving our model. And every day we do new things. In fact, with the COVID vaccinations, we now have an app to track COVID vaccinations, which UNICEF wants to use in Africa. So, as you have knowledge, people come to know what you're doing. You're able to do things better and better that are in that particular area. I still don't understand a lot of the jargon in healthcare, but if I was zero earlier, I'm probably at 20, 25 right now. So I think you've got to have a passion for it. You've got to want to make a difference. And you've got to come from that background, in the sense, if I was a power engineer, I wouldn't look at this. I would probably look at something more connected with power generation or solar or something like that. So I think you have to leverage your expertise. That's to the first point. The second point of how do you work with government? Government has a major infrastructure. I don't know if you know, you have a district health officer in every district. In every village, you have a ASHA worker, you have an Anganwadi worker, and for every 10 or 15 villages, depending on the population, you have an auxiliary nurse midwife. Right. Now think of the infrastructure that already exists that the government is paying for, but it's not effectively used. It's not providing the impact that it can provide. So if you can find a way to leverage it better, and there are NGOs I know that are doing that, where just by providing them a tablet or a smartphone, all three of them have to enter registers. They can share their data, and all of a sudden you're much more efficient in terms of identifying, say, pregnant women who need care, et cetera, et cetera. So, this particular NGO called Antara Foundation addresses the problem of malnutrition and infant mortality. And they've done quite an amazing job in Rajasthan and now in Madhya Pradesh and Chhattisgarh. But yes, the government has that infrastructure. Now, going to the government and saying, hey, I want to do this in your state is unlikely to work, because they've got 50 priorities. And plus they are suspicious of people who come in and charge anything. If it's free, they might agree. But if you say I need to charge 15 rupees per transaction or whatever your number, they are suspicious of that. And they also feel that someone will say that they're getting a kickback and they'll get into trouble. So the best thing to do is what we did, at least at Evolko, is we went and identified a host hospital, persuaded them to start a telemedicine kind of location, and then went to villages around it, about an hour or so away, where they would not come in normally to that hospital, and started this whole program. Once the program was established and running, and the benefits were visible and measurable, then we went to the government. And you're likely to find some good minister or IS officer who likes what you're doing and then tells you to go to a different district. You might even find an MLA who thinks that, hey, I can do this in my district, it'll make more people vote for me or whatever. And that happens. And we've also had in Bihar, we've had one of our telemedicine operators who's become an MLA because he became so popular. So, you're seeing all that kind of happen. It'll take time. It just takes time working with government, but you have to work with them if you want to scale, especially in areas like this. And again, another example I'll give is if you look at education and look what Delhi government has done in their schools and what the difference they've been able to make in a few years. If you focus on a problem, you can get it done. I mean, I saw a number of messages which said that we should improve livelihoods, we should do everything. Yes, we should. but trying to do everything, nothing gets done. So like any entrepreneur, focus is the key. If you focus on what you're doing and try and improve that, and also, in my view, if it's a social enterprise, try and make it self-sustainable, at least initially, you will find that that works. Because as it grows, something like Evolko at 15 and 25 rupees a transaction, we are now billing, I think, about $400,000-$500,000 a month, right? So the volume is huge in India. I mean, and we've just scratched the surface. We've only gone to 3 or 4 states. I mean, there are 20 plus states. So it's just an amazing market if you can do it and do it right. And if you can scale it, and today you've got a lot of tools. You've got AI, you've got ML. I mean, you've got a lot of tools that can help you do things that you couldn't do that easily before.
Thank you, Arjun. Next, we go to Meyyappan. Meyyappan, again, there are several folks in the audience. I'm sure some in India, some outside of India who are tuning in, and specifically focusing on their interest to enter this impact ecosystem as an investor. Maybe they want to do it as an angel investor. Maybe they want to become a part of an angel network. Maybe they want to become a limited partner or an investor into an investment fund. What are things that they should be aware of? Firstly, again, going back to this whole debate about, is impact investing necessarily mean muted returns, or can it be as high as the regular commercial venture funds? I'd like you to throw some light with respect to what have you seen from your firm's fund practice in terms of the projected returns for some of these impact investment related transactions, either at the individual social enterprise level or at a fund level. What are the kind of the IRRs that you've seen? That would be one thing that would be helpful for the audience, I'm sure. And secondly, in terms of some of the challenges that they have from a legal standpoint, especially in a cross-border context. I've heard many people in the US who say now they won't touch with a barge pole any India incorporated entity because the KYC norms are so Herculean. Whatever returns, minor returns that they might make after the foreign currency differences and so forth, the hedging there, that it's just not worth their time to kind of deal with all the headaches that happen. So is it really all that bad, or has the government done anything to kind of make it more easier for foreign capital to find its way to India-based social enterprise and India-based impact funds? And in this context, you might also touch upon with respect to what's happening with the social stock exchange. Is that going to make things any easier for those who want to engage with the social enterprises in India? Over to you, Meyyappan.
Sure, Sanjay. I think lots of good questions there and some that come up all the time. So I'll just quickly lay out what the legal framework or what are the considerations parties need to keep in mind if they are especially investing from an offshore location. First is, if you're looking at a social enterprise, I think there are exchange control laws that will determine which route you take to make the investment, whether it is equity, debt, or into a non-profit. So the first thing you're going to be worried about is the social enterprise structured as a non-profit or as a for-profit? If it's a non-profit, then there are restrictions under the FCRA route as to what money it can receive as a grant and how it should be deployed in alignment with certain purposes. That's usually not the preferred route, because despite the fact that on ground, from my understanding, close to 50% or more of the social enterprises are structured as non-profits today. And as non-profits, it's not just Section 8 companies, it's also your charitable trusts, societies, and other organizations. On the for-profit side, of course, I think in terms of bespoke investments, we've seen equity and more of equity and a little bit of debt transactions as well being considered. On these, on the equity side, the main consideration from a regulatory perspective is, again, which route you're coming down through. Is it the FDI, foreign direct investment route? Is it, typically for smaller investors, I think the regulatory regime is too complex and the transaction costs are quite high, which I think are also may dissuade investors from getting into this space. But for the larger investors, the choices are between, do we come down the FPI route? Are we coming down the FVCI route, which is the foreign venture capital investment route, which gives more liberal conditions with respect to certain specific sectors that the government wants to encourage investments into. And then we also have the funds that a foreign investor can invest in, right? So this is the whole range of vehicles and the routes that you have available to invest. But as I said, for a smaller investor, the cost of making such investments and the compliance aspects may not make it attractive for them to get into this space. The second thing you had asked was in relation to, that's just on the regulatory side. And then the other aspects in relation to these investments are on the tax perspective as well, right? So even when you're making equity investments, valuation at the time of making investments or at the time of exits, these have been historical problems with respect to even regular cross-border transactions, which continue to play a role in these investments as well. On the debt side, we have seen specifically certain investors highlight that if they want to invest in an NCD, I think the two issues for them is under the regulatory regime that the minimum maturity period is at least 3 years, and in many cases 5 years or 7 years. And also the interest rate caps, which are too low for them to get the advantage of the 5% cap on interest payments, right, in terms of taxes payable. And of course, in a cross-border context, from a tax perspective, you also look at which country you're coming from, the applicable tax treaty, whether you'll be able to get a credit of it where you're based. All of this gets into the the ultimate IRR that you get from an investment that you make. Now, in terms of some of the funds that we have that I'm aware of in this space, my understanding from my discussion with the funds team is that I think in the impact space, the returns range between 10 to 12%. And even in some of the impact bond structures that we have, we are currently working on, it is around the 10% mark is the returns that we are seeing being negotiated. This is in a principle behind this appears to be that keeping in mind that these are social finance transactions or impact investment transactions, I think commensurate to the impact, the financial return expectations do seem to be possibly sometimes on the lesser side in some cases, but also at the same time, they are in line with market returns in some cases as well. So it's not that in every situation we have seen that financial returns take a hit. It really depends on what the investors' objectives are, and some of them are willing to say that I'm okay with a flexible return to some extent, so long as the impact is achieved. And there are some investors who are very focused on the impact first investing, that the returns themselves are triggered only if the outcomes are achieved or if the impact is achieved. And there the negotiation is a lot around how do we define impact, how do we measure it, and it gets away from a more principle-based sort of impact assessment to a very specifically defined and carved out impact on pre-agreed metrics, etc. And that's a lot more difficult and smaller range of transactions that do that. The larger set of bulk of transactions are actually more on a principle-based approach. In fact, a lot of the LPs who are either like the IFC or development finance corporations have started putting in some of this principle-based language in the fund documentation, with saying that the focus should be on avoidance of harm, ESG metrics to some extent, and also to some extent on impact as well. That's very quickly on that. Now, with respect to the social stock exchange, yes, I had spoken a little bit about what the good work that they have been doing. However, there has been no announcement pursuant to the last year's announcement by the finance minister. Currently, the report is being finalized with a detailed set of recommendations, which are intended to open up the sector and enable free flow of capital to both non-profit and for-profit social enterprises, with the measurement metrics that they're trying to put out. But once the report is placed before the government, it's unsure. I mean, it's difficult to guess whether the government will act on it, or on which portions of it they will pick up and actually enact into law. So that's something that may take a little while to move on the legal front. The Any other aspects? I hope I haven't missed out.
No, you
All right.
covered everything. Thank you. Yogesh, we are reached the final 10-12 minutes of the session now. Do we have any questions from the audience that you'd like to bring in?
Thank you, Sanjay. Thank you. There have been a whole lot of questions from the audience, and you have already covered a significant part of them in your conversation. Now, I just want to, here are a few very specific information, few attendees would like to know.
Sure.
And it would be useful if someone from the panel could help them understand it.
Okay.
Of course, can somebody describe in a very simple terms? Here's a question from Kalpesh Upadhyay, which I'm sure resonates with many of the attendees, that if you're a small individual investors, how can you participate in this impact investing? How do you do due diligences and things of that kind? So Mukesh or Vikram, would you like to?
Meyyappan, maybe we'll begin with Meyyappan and maybe Mukesh might have a point of view. Meyyappan first, over to you.
So that's a good question. Unfortunately, as I said, because transaction costs today seem to be high, we have generally seen the bigger players and larger transactions go through. But having said that, I think the starting point, as I said, if you want to make an impact investment, there are certain clearer areas or routes through which you can do it. One is, of course, you'll have to identify a recipient entity, which is, and depending on whether it's a for-profit or a non-profit, you can make the investment under the applicable routes, either under the FDI route or the ECB route, or the FCRA is a little bit more tricky. So that then anyways, return expectations are difficult there. But equity investments or debt investments should still be doable. There is no ticket size there, unlike in a fund structure where you may have to put in a certain amount. I think 1 crore is the ticket size for that. So these are probably the easier options to do. Equity, I mean, keeping in mind the valuation problems that may come up, you still have the right to, I mean, freedom to exit and at any point in time, unlike the debt route, which may lock you in for at least 3 years. So there are some considerations to keep in mind. The sector is not, I mean, the law is not really geared towards encouraging the smaller cross-border investors to do it, but it's not possible.
Sure. Mukesh, did you want to add to that?
Yeah, I think one would really need to worry about the sustainability of an enterprise. So sufficient amount of capital and resources will need to be given. I think the question was focused on diligence. So Indian Angel Network has an impact segment now within it. So you could probably participate through that Angel Network. Then there are incubators like Willgrow. So you can, Willgrow does due diligence on many of its incubators. There are now 4 incubators created. IIT Kanpur has one of them. So there are 4 incubators like those. So you could, do it through one of them or alongside them. And like Meyyappan said, you can do it in a fund also, because 1 crore rupees is drawn over 3 to 4 years, right? So it's about 25 lakh rupees a year sort of a number.
Vikram, I know you have a angel fund under the Ivy Cap umbrella. They might not be focusing on conventionally defined impact enterprises, but do you have any points of view to share to people who want to dealing with small ticket size investments?
Yeah, I think the important part here is Meyyappan mentioned that if you're investing in an AIF 1 category fund or AIF 2 category funds, so obviously there's a ticket size issue of 1 crore. But then there's a new category under AIF 1, which is Angel Fund AIF 1 category, under which they have allowed 25 lakh ticket size, which actually is a better option, I would say, as compared to investing through an angel platform, because angel platform, you're getting direct exposure to the company, and the due diligence and the exits are pretty much your own risk. When you invest through a venture capital fund, doing an angel fund, typically, because they do it as a full-time with a lot of focused activities around it, there's the due diligence aspect that you talked about in the question is significantly addressed at the time of investing. So making sure that, the investment meets all the criteria of the entrepreneur's backgrounds, the impact aspect, and the exit time frame, etc. So So our angel fund, for example, that we set up, it's a small fund, 60 crore size fund, which is specifically targeted with that intention to invest in very early stage seed and pre-seed stage companies. And a lot of that is also going into impact. So we're using the SDG framework, in fact, in part of those investments. So that's one of the ways one could make investments in that space.
Thank you. Yogesh, next question, please.
Thank you. I'm a lot of conversation has happened on concepts and principles. Here are two very specific requests that have come in. This is from Ravi Kumar. He's asking that we have been used to CSR in India and impact investment. Can you help us in sourcing funds under impact investment in long-term sustainable projects for harnessing water resources? Why I'm taking up this question is from a entrepreneur perspective. How can an entrepreneur access these impact investment funds? So would request Mukesh or Vikram to sort of help us understand that.
Either of you?
How can a social entrepreneur source funds through impact investment route?
That's a very broad question.
Yeah, they can.
Very short question.
Yeah, they can directly reach out. They can directly
access impact investment funds.
Yeah, if it's a for-profit enterprise, they can directly reach out to the funds that fit with the mandate. So, for example, we invest in healthcare, agriculture, and education, 3 sectors. So, anybody is operating in these 3 sectors, our criteria is on our website, and like that, every fund has. So, you can look at the Impact Investors Council website. Most of the impact investors are covered there. Not all, but most of them are covered there. And whichever one is most aligned with your area of work, you can directly reach out to them. Vikram.
Just to add to that, I think if you're specifically looking for water as an area, as an example, so there are quite a few ventures which are actually focusing on that area, and I'm aware of quite a few of them and working with some of them, and they're very passionate about solving that problem. But I think I haven't come across a fund which would actually say that that's the only area we are focusing on. So I think you probably will have to go through a fund which is actually looking at impact as an objective, and within that they would have identified maybe water as one of the areas, and there are quite a few funds like that in the country. We ourselves are looking at water as one of the main issues and are looking at very interesting opportunities there. But for us, the bar is very high when we look at various factors, including the entrepreneur, including the real impact on the ground and the value creation. So therefore, we look at multiple factors, but I think the options would be accordingly segmented for you.
Thank you, Arjun. I would like to take the next question again on a similar format. Here is a gentleman who has created a fund. Now he's inquiring about, he says, I've heard you mention about ways of measuring impact from investors' point of view. We have just closed a new impact fund and are looking for help in defining how we can measure impact from investors' point of view. So would Vikram or would someone like to respond to this? How can impact be measured from investors' point of view by a fund wanting to invest in such social enterprises?
I can just briefly touch upon this. And I think if you look at the DFIs, and we've done this mapping, in fact, we've looked at CDC, IFC, BEG, and quite a few other DFIs who actually, very interestingly, define their own yardsticks in terms of what they look for when they look at impact investing. In fact, they are investing in funds as fund of funds. And even when they're investing in fund of funds, they give their own template of measuring the impact. So effectively, in a way, they are directing these funds to make such investments and then report to them on very specific criteria of measure of impact. And I talked about the SDG goals, for example. Most of these DFIs will actually pick specific areas within these SDG goals and again segment those as either a mission or something which is important to them or something which is a priority area for them. And accordingly, based on that, they will give their own priority areas of measure of these. So it really depends on, what's the source of capital and what particular factors they're driving.
Thank you. There are far too many questions from the audience, but knowing that we have a time limit, we are almost at the close of our time that we had set up for our webinar today. I would like to hand it back to Sanjay for concluding today's session.
Yeah. Maybe we might take 1 or 2 minutes more, but I'd like to get this from the two investors on the panel here. Again, you've been in the investing domain for a while, each of you, Mukesh at Menterra and Vikram at IBCAP. And just looking at the entrepreneurs that you've interacted, the enterprises that you've invested in, if there are some common themes that you see with respect to which of these turned out to be successful in the end, or just that process of engaging with the entrepreneur in the enterprise was most satisfying, and by extension, who are the aspiring entrepreneurs, maybe they can fashion themselves around these successful attributes of these entrepreneurs or the enterprises they build. Maybe quickly address some commonalities that you observed from the entrepreneurs and the investments that you made. Maybe first Mukesh and then finally Vikram.
Yeah, I think
Mukesh. Go ahead, Mukesh.
Most entrepreneurs, can you hear me?
Yeah.
Most entrepreneurs start with a lot of passion, right? So we have seen that, as investors, it is our responsibility to, create a good execution engine around them, right? And wherever we have been able to create that execution engine, we have seen success. So I'll just share one quick example, a company called Biosynth, which was a, DOM startup, IIT Bombay, young biomedical engineers and doctors really disturbed the amount of malnutrition they saw around them. And they created India's, first non-invasive hemoglobin measurement device, first glucometers, and almost 30% of swaps during COVID were done on their panels. We exited that with great returns. They were able to reach more than 20 million patients in villages of Gujarat. The WIN Foundation, which is an entity of Wheels Global, have used that in villages in Gujarat. Wadhwani Foundation is used in villages in Rajasthan. So there are many such examples, young technologists, entrepreneurs coming out of our institutions, but we need to create an execution engine around them, and they will continue to remain resource constrained. So making sure that they have right level of resources to really deliver on that, I think are two important areas that we have seen, two important ingredients for success.
Okay, thank you. Vikram?
For us, it's very, very clear. I mean, if you're talking about the commonalities from success factors perspective, it's very clearly the entrepreneur and the team. Effectively, the passion and the quality of team has made a difference. And while of course most of our support system comes from the IIT alumni ecosystem, but I think we've seen also from the entrepreneur perspective, there is a lot of drive when it comes to the technology entrepreneurs. And Arjun talked about some of these new technologies, artificial intelligence, machine learning, IoT. Some of these technologies, the entrepreneurs who really actually using these technologies on the ground and really making a difference in terms of targeting these technologies for very specific use. For example, we recently invested in a company called LUC Data, which is actually using AI technology for drug discovery, and they've created a very interesting platform, addressing the entire problem of bringing drugs to the market much faster. So I think it boils down to the passion of the teams and the backgrounds, and then really the focus they have to solve these specific problems. So I think it's all boils down to, as Mukesh said, execution.
Thank you. Maybe Arjun, from your experience of Evolko. Sorry, Mukesh.
Sanjay, I just want to add one. I just want to add one more point.
Yeah.
I think for anybody investing in impact from this group, needs to remember that the economics of serving a small farmer with less than 5 acres land and delivering quality education to children who are going to schools where the annual fee is very low, 15,000-20,000 rupees per annum, or government or charitable hospitals, the economics of that is very, very tricky. And that is very important to understand the unit economics and making sure that you are designing it for success. Arjun shared a great example, and I'm sure he's going to add more, but that's an important point to remember.
Thank you. Thank you. Arjun, yeah, from the Evolko experience, again, to the aspiring social entrepreneurs, what is it that they need to be aware of, steel themselves for design the team and the organization around them for success?
Yeah, so just focus. I mean, I think that's the most important thing. You have to know what you want to do, and then you have to focus on how to get it done. Look at all the variables that you've got to address and try and, just manage those variables. Start small. Don't try and change the whole world at one time. I mean, if a friend of mine once told me she gave up her dental practice in Houston and went around the world at all these hotspots like Rwanda and Serbia and stuff, working in UN refugee camps. And she came to Delhi and she had a tummy upset. She came and stayed with us. My mother was a doctor. And so I got time to talk to her and ask her, why do you do it? And what do you do that makes a difference? And she said she does little things with lots of love. And I think that's the way you've got to address it. Just
Wonderful.
Passion, love, it's got to give you satisfaction. And really making a difference for people, it changes the world, And remember, you're an outsider. When I go to a village, they don't take my word. I have to use them to communicate to them. So there are lots of changes you've got to do. I mean, they probably trust you after a while, but initially you're an outsider and they don't trust you in most places. So I think what I would say is, like any entrepreneurial enterprise, focus, have a common message. Everyone's behind a common goal, and just get it done. And of course, everyone said, know what your impact is, know how to measure it, so that you know what you're doing, and that it gives you the measurement that you're looking for.
Thank you, Arjun. And the last, Meyyappan, yeah, you come from a law firm, a legal standpoint with respect to what entrepreneurs should be aware of and be mindful of, before they launch their enterprise to change the world.
So I think as I said, the legal regime is extremely complex. There are certain things that you need to take a call as a social entrepreneur when you start out on the process, which is the first question is, how is your company going to be structured? Is it a for-profit or a non-profit? And you have different sources of capital that you're going to choose, that you're going to get. And I know for a fact, some people get grant money in the beginning, so they go ahead with the Section 8 and then later realize they can't take private, like angel funding. So that's something we have put out a paper. It's been nominated for a pro bono award last year. It's called Impact Investing Simplified. So do take a look at it. It will set out what are the broad laws that you need to be aware of that apply to from a social entrepreneur's perspective or from an investor's perspective as well, so that this is the legal regime that you are navigating, and some difficult a wrong choice at the beginning that you make may make it difficult to receive certain kinds of funding in the future. So that's a call that you need to fully consider all the factors and take a knowledgeable call at that point in time.
Wonderful. Thank you, Meyyappan. So yeah, we've maybe about 5 to 7 minutes beyond the intended 90-minute duration. We've come to the end of the session. Again, I want to thank each of the panelists for taking the time to be part of this session and for sharing their insights. And I think almost all of them have shared their contact details with the attendees, and you're welcome to reach out to them post the session. I want to thank the Wheels team again for the really impactful work that they are doing on the ground in India, leveraging technology for scaling social impact. Suresh, Hiten, the entire Yogesh and Ambassador Kapoor, the entire team for the wonderful work, and even this webinar series that you enabled, the impact sector leaders to come to be convened and for them to share their knowledge and their experience and wisdom with the aspiring entrepreneurs and investors. Again, a place like India, huge problems. We need all the entrepreneurs and all the well-intentioned folks, be it as investors, be it as mentors, to come together to solve the mega problems of the country. So with that, I conclude the session. Over to you, Yogesh.
Thank you Sanjay for such a wonderful moderation, such a wonderful session. I would just like to share 2-3 key takeaways that I take from the session today. And the most important one was, I take it from Mukesh, that the intentionality is the cornerstone for defining a social enterprise. And that's really the key, one of the key, how do we, the way we understand a social enterprise. Second key takeaway I take from Vikram, and where he shared about his observations about a family office in UK, measuring impact versus returns. SDG framework can actually generate higher returns. So these two wonderful takeaways from our session today, I think summarize that whenever we're investing, whenever we're looking at investors, looking at the SDG and looking at the intentionality will add a lot of value to it. With this, thank you. Anything else, Sanjay, you want to add? Otherwise, we thank everybody, all the participants, all the panelists. We'll see you again in an upcoming webinar. We'll be sharing information about that webinar through emails, communications. Do stay connected with us. Thank you and have a great day. Good night to wherever you are. Good day and good night.
Thank you. Thank you.
Thank you.